Hi there, this is Rava with Rava Realty from New York City. So I want to touch about a couple of market trends that seem to contradict each other, but do they really? The first trend is about rental prices. If you're a renter in Manhattan, the last 2 years have been fairly kind to you. The market report from Miller Samuel, appraisal firm from August of 2018 confirms that the rental market is still soft. The only segment that appreciated in terms of median rental prices was the studios. That was a 2.4% increase, while 1, 2, and 3 bedroom homes rental prices declined year over year. Specifically, 1 bedroom home price for rental went down 0.3%. The 2 bedroom segment went down 2.4%, and the 3 bedroom home segment went down a fat 8.5%. So if you want to rent a large apartment in the city, now is the time. Especially the luxury segment is suffering, and you can take advantage of the offers that are out there in the market. But what is causing all this activity in the rental market? Because transactions are there. There's the number of transactions is actually up compared to last year. Well, concessions. What are concessions? It's real help that comes from the landlord to the tenant in the form of maybe a 1 month free rent or owner paid broker commission. So in the last 3 years, these concessions kept growing at a steady pace, and recently they reached a peak. Nearly 1 in 3 rentals this past summer came with some sort of incentive to the tenant. So definitely a very high percentage compared to historical trends in Manhattan. A borough that did a little better within the city, it was Queens, where prices have been more stable and showed some increases. Which takes us to the second market trend I want to touch on. Large investment companies are buying a lot of New York City real estate, specifically multifamily properties dedicated to rentals. So if the rental market is generally soft, why are big investment companies like Blackstone Group, for example, buying a 1,300 units apartment complex in Queens for $500 million? These acquisitions of multifamily buildings are on the rise. In particular, they reached the $5.3 billion mark in the first half of 2018, an increase of 64% from the previous year, according to a study of Ariel Property Advisors. There were 6 transactions over $100 million in that period of time, compared only to 1 in the first 6 months of 2017. So what is causing all this activity? Seems like there is a meeting of the mind situations where buyers or sellers are, finding an agreement in between. A lot of buyers understand that after this pipeline of available properties is gone and sold, there will be little left to pick from, and sellers might be incentivized to sell when interest rates are becoming a little more expensive. On the other hand, investment firms and the funds can handle the changes in interest rates. They're set up for long-term ownership, and again, we're in a situation where there's this meeting of the minds and transactions are actually happening. So if you're considering an investment in New York City, you can decide to follow the example of these large investors that are definitely bullish, and they believe in the future of the city, and they are showing it through their investments. Obviously, knowing how to navigate the different areas and neighborhoods is very important, and I'll be glad to be the one guiding you through this process. Thanks for watching. Please give me a thumbs up if you like the video. If you have any questions, if you want to chat more about these things, you feel free to call or text. My cell phone is 917-214-2509. I also appreciate if you leave a comment in the feedback section below and if you share this video with your friends.